on this computer. All right, we are recording. Yeah, I mean, you do have some of the niche markets that are still at very, very high levels. That's not a good combination. But let me just find the material I prepared for this. And so the overall theme coming into 2023 is not that the demand has collapsed, but it's continuing to be extremely depressed. So let's jump through both the ramifications, first on the demand side, then on the supply side, then on the rates, and then some views on what's going to transpire here in the rest of 2023. If we start out from the global view, global demand already collapsed back in September. When we look at global developments, I usually look now only at TEU miles because that's the only thing that makes sense from a global view. And in September, this dropped off a cliff. October and November, the same. This is based on loading date. So November cargo is cargo that's loaded up until the end of November, and so far reflects the newest data out there. A concern could, of course, be that the large decline here in September, October, November, it could be because we had a strong year last year. So maybe the market is not all that weak, because if you look at this, the decline is basically the same decline as we saw when the pandemic hit, but maybe it's an annual effect. And to test that out instead, what I then also did was look at TEU miles every month in 2022 globally and compare to what did it look like back in 2019. But when you do this, you still find the market dropped off a cliff in September. September, October, November, it's fluctuating a bit, but basically we are 5% lower on global demand than even before the pandemic. We are back to a level that more matches where the world was in 2017 or 2018. This is a very clear signal that the global container demand market is indeed very, very weak, has been for several months. That's the global view. Given that some of the most important trades are also the long distance trades, it's even more disconcerting if you then look at the demand development on those trades. If we first look at Asia, Europe, and Asia, North America, what you see here is the orange line are growth rates compared to 2019, so before the pandemic. The blue lines is the usual year on year. For Asia, Europe, we are 20-25% down on volumes. Compared to pre-pandemic, we are still down. November looks kind of okay, but that's because November before the pandemic was actually quite weak in Europe. The Trans-Pacific into North America is even worse. North America during the pandemic was a key driver of a demand boom because the US consumers in particular bought a lot of goods. We started out 2022 in some cases with demand being 50% higher than 2019. That's now all gone. We are back to 2019 levels. On a year-on-year basis, Trans-Pacific volumes were down 27% in November. That is an incredibly poor performance. But it's not the only ones. If I look at a different trade, look at Asia to South and Central America, also based on container trade statistics. And of course, then also the export trades back to Asia. We again refine the same patterns. If we look at the orange and blue lines, imports to South and Central America, year on year, they look strong. You're growing 10%. The problem is that's because the last few years were incredibly poor. Volumes from Asia to South and Central America are still 10% lower than where we were pre-pandemic. We're looking at the exports, and of course, this is combination dry and reefer. I don't have it separated out here. The market is, again, 5 to 10% lower than pre-pandemic. And on a year-on-year basis, it's now down almost 25% on export volumes. So when I look at all the deep sea trades, including the ones that are including South and Central America, demand is just dropping off a cliff in the last few months of 2022. There's a couple of reasons for it. One reason is inventory corrections. There's a lot of importers to some degree in South America, especially in North America and Europe, where the importers are beginning to reduce their inventories. And when you reduce inventories, you don't produce new goods. And that, of course, impacts container volumes extremely hard. That's a temporary phenomenon. But then there's another phenomenon, especially in North America, that's beginning to unfold. That is, what are the US consumers spending their money on? And what I'm showing you here is US consumer spending. How much of the money does the US consumer spend on goods relative to on services? Not in dollars, but in percentage terms. And what you can see here is, as the pandemic hit in 2020, there was a large shift to buying goods and not services. That makes sense. People couldn't spend money on services. There were lockdowns. But you can also see what is slowly beginning to happen now during 2022. Consumer behavior is slowly beginning to go back towards normal. This is not over yet. So over the course of 2023, you are likely to see the consumers normalizing even more, which is going to put a negative impact on container volumes as consumers gradually revert back to service spending. So demand has collapsed, and there are still negative indicators to demand for the rest of 2023. That's on the demand side. If we look on the capacity side, we need to start with reliability still, because reliability is what soaked up a lot of capacity. And the latest data shows a continuing improvement trend. We are not back on on-time performance where we should be as prior to the pandemic, but it is clearly improving rapidly. The delay of vessels is also improving rapidly. And if I take the delays, I have this model where you can calculate how much of the global fleet is unavailable because vessels are stuck somewhere in a queue. This has been the development. The worst was beginning of 2022, where basically 14% of the global fleet was not available. The newest data that goes to the end of November shows it down to 5.5%. We can also see in a normal market, there's always congestion somewhere. There's always vessels delayed somewhere. So under normal circumstances, 2% of the fleet is never available. I mean, that's just the baseline. But we're now down to 5.5%. And at this rate of improvement, we should be back to full normal vessel operational availability by the end of Q1. We should expect to see normal levels of reliability, normal levels of delays by the end of Q1 here in 2023. If there are no other curveballs coming at us. This is a very rapid pace of improvement. We can also see the improvement in the Flexport index that they are publishing weekly. So that goes up slightly newer than the reliability data. They provide data on the time it takes for cargo to move from exporter to importer, so not just the sailing time. And that just continues to improve as well. You can also see here we are not quite down to normal operational levels, but we are approaching it rapidly, especially on Far East westbound, so from Asia to Europe, where now we are approaching 70 days of time, where the norm was around 60 days. So rather than cargo being 2 months delayed compared to normal, that is now down to a 10-day delay, which is a massive improvement in the supply chain. From the customers, that's good news. That means the supply chains become shorter, more reliable. From a market perspective, that also means demand is dropping, and we're getting more and more capacity because we're getting all these delayed vessels released. That, of course, weakens the overall market dynamics to an extreme degree. We have massive overcapacity all of a sudden. This impacts pricing. Let's look at first the spot rate parts. If we look first at Asia, Europe, and Pacific, those are the two blue lines. Rates dropped dramatically during 2022. The initial decline we see in these curves, that is because capacity began to be released as bottlenecks were slowly improving. That drove rates down, and then rates drop even more as demand collapsed. It would then also appear that the drop has now stopped. Rates from Asia to Europe, as well as on the Pacific, you can see have flatlined over the past months. So it would appear, yes?
It's stopped due to the Chinese New Year, no?
Yeah, this is data up until Thursday last week, so just before Chinese New Year. I'm going to have more words on Chinese New Year in a second, so bear with me here. But for now, we can see the nominal rates have stabilized. They're not falling anymore. But let me just put a word on transatlantic. Because given most other trades seems to have collapsed, the transatlantic have remained quite high most of 2022, and only in the last few weeks have we really began to see it drop rapidly. This is partly because you had massive congestion problems that appearing on the US East Coast over summer last year. And when you have congestion problems on the East Coast, that tied up a lot of the vessels that were operating on the Atlantic. So the Atlantic market was extremely strong, not because of demand, but because of a shortage of capacity. This is a temporary effect. As we are now getting more and more capacity released, it's very likely transatlantic rates are now going to drop rapidly in the coming weeks and months. It's going to follow the path that you see here for Asia, Europe, and Pacific, because there's no longer anything to sustain those very high rates. But it is an example that for extended periods, you can have trades that remain stronger than what you see on the deep sea trades, but it will be a temporary effect. Now back to the impact of Chinese New Year, because it's true, rates have stabilized on Asia, Europe, and on the Trans-Pacific. However, we always in the markets have a seasonality effect of Chinese New Year. The norm is there's always, after Golden Week in October, a rate decline. We hit a bottom sometime before Christmas, and then rates usually increase up to Chinese New Year. The increase we see here is quite small. So the question is, how big is this effect compared to normal seasonality? And this is what I get if I model. If we look on the left-hand graph first, here I've taken the years from 2013 up to 2020. I excluded 2016. We had a major price war. That's an aberration. And of course, the pandemic years were weird as well. I included 2020 because the pandemic only really impacted after Chinese New Year. So what I looked at here, from that bottom we usually have prior to Christmas until the peak before Chinese New Year, how much do the rates usually increase leading up to Chinese New Year? On Asia, Europe, the standard, the average is about 50% rate increase. But this time we've seen only a 13% rate increase. If we look at the Trans-Pacific, we see the same phenomenon. Normally rates should have increased a bit more than 30%. They only increased 5%. So the reality is, if I just go back one slide, it would be misreading to say the bottom has been reached, the market has stabilized. Yes, in dollars and cents, the rates have stabilized, but in reality, they have dropped because seasonally rates should have increased a lot more leading up to Chinese New Year, and they didn't. That means the market is a lot weaker than meets the market, that meets the eye out there, and it is exceedingly likely that now we get into the post-Chinese New Year, rates might begin to dip even further if the carriers don't cancel enough capacity. More on the blank sailings in a few slides' time. But this was all the spot rates, and I wanted to focus on the spot rates because it is the most up-to-date indicator of what the market is right now. Contracts are, of course, always lagging behind what we see in this market. But if we were to look at the change, Senita up in Norway provided some rate statistics a couple of weeks ago, where on the major deep sea trades, they simply looked at what has happened to contract and to spot rates from the end of 2021 to the end of 2022. And it exemplifies extremely well just how big a change we've seen in the last 12 months. Where if we take an example here, Far East to US West Coast, we started out a year ago, basically with spot rates being $3,000 higher than contract rates. And we end the year with spot rates being $4,000 below contract rates. That's, of course, also what has led to a lot of turmoil in the last few months, an enormous amount of contracts being renegotiated and altered, and or shippers simply not moving any cargo in accordance with contract because they could get these massive discounts on the spot market. That's a pressure that's going to continue. That's also why if we want to look at a market rate development in a deeper sense, it's not enough to look at spot rates because spot only part of the market. What I find instructive at times is to look at the rate index provided by Container Trade Statistics. And CTS does not provide this in dollars per FFE. It is an index and an index only. So it only gives relative movements. These are three of the key indices. There's Far East to South and Central America, and that's the blue line. Got the orange one, which is Far East to Europe, and you got the gray one, which is Far East to North America. And from this perspective, it would appear that South America did not see quite as much of an increase as the other trades. However, and again, there is an however here, you will note that before the pandemic, they were not all on the same level. The way CTS has defined the rate index is that for all trades, the rate was equal to index 100 back in 2008, so 15 years ago. So if we are to really look at the developments here over the pandemic period, I have recalculated the rate index and said, what if all these three is at index 100 before the pandemic? So for average 2019. This is what then transpired over the last few years. You clearly saw the largest rate increases, the most massive increases on Far East to Europe. And this is all spot, contract, everything. Then you see the Pacific being at the bottom of this, and you see Asia to South and Central America being more or less in the middle. The early parts of the pandemic, rates to South America increased substantially more than rates into North America. But you're also seeing the decline now. They are declining very rapidly, already approaching the North American ones. So South America was clearly not as badly affected as the worst impacted one, Asia to Europe, but it was more impacted than the market we saw up in North America. I also just want to have a look at the global rate index in a longer perspective. This is the covering all trades around the world, all spot, all contract, everything. And what I want to take away from this is not the extreme height of the peak. That's fairly obvious. What I want to point out here is something different we haven't seen before. If you look at all the previous peaks in 2009, 2012, and so on and so forth, the normal pattern has always been that rates go up rapidly and it takes a longer time for the rates to come down, usually. If you look at the first peak, which is the peak following the financial crisis and then the price war, that's fairly evident. Prices go up quick and they're slower to go down. Right now, we are seeing the opposite. We saw a rapid increase in rates as we came into the pandemic, but the pace of decline we are seeing now is even faster. This is an unusual pattern. So we have reversed what tended to be normal. And that also means we can revert back to not only normality, but see rates, and we already see that on some spot rates, drop even below pre-pandemic levels faster than anybody could have anticipated. The carrier's counter move towards this extremely weak market development is, of course, to start to blank sailings, to remove capacity. Let's just have a look at what they have done here. What I'm showing here is the amount of capacity that has been canceled immediately following Chinese New Year. So it's a period from right now and 3 weeks into the future. If you look on the left-hand side, that's the Pacific into the US West Coast. You're going to see the carriers cancel almost 36% of the capacity in the next 3 weeks. This is almost as much as what they canceled in 2020 when we were impacted by the pandemic. This is a very, very high level of cancellations. You see on the trade from Asia to the East Coast, the carriers are canceling even more capacity than what they did during the pandemic. Now, of course, this is a large amount of cancellations. What about the underlying capacity, especially from Asia to US West Coast? The amount of capacity, so not blank, but the capacity actually operated is the lowest that we've seen since 2015. If you look at the amount of capacity the carriers are going to operate in the next 3 weeks, it is the lowest seen in 8 years. So there's an extreme amount of capacity reduction in the market. And this is something the carriers have done very, very lately. The small bars on the bottom of 2023, the light blue bar, that's the amount of capacity the carriers had blanked as per their announcements 4 weeks ago. So it's only in the last 4 weeks that the carriers have suddenly become extremely aggressive in canceling more capacity. That, of course, seems to be in realization that the market has indeed collapsed. How are they going to stop the collapse in rate declines? If we are to compare to the pre-pandemic period, it would appear that the most the carriers can hope for in doing this is to prevent a further rate decline. But whether this is enough, we'll see in the next few weeks. We see the same thing, especially on Asia to North Europe. The carriers are not blanked quite as much capacity as during the pandemic, but at 32% blank sailings going up to North Europe. it is still a massive impact in the short term. What about the rest of 2023? I mean, one thing is that demand is down now. What is going to transpire? And there's a couple of ways to look at it. Let's look at first what is about to not to happen, because normally there's a reasonable link between container volumes and global economic activity. It's also sometimes called the multiplier. If we look at the last 5 to 8 years, that multiplier tends to be between now 0.5 and 1. In the old days, there was a rule of thumb saying it was 3. That's no longer the case globally. And if you look at the economic outlook from reputable institutions like the International Monetary Fund or OECD or any of those institutions, you get the demand forecast you can see here in the green and blue line, and that looks fairly okay for 2023. I don't think that's going to be anywhere close to reality. What we're seeing right now is a massive demand decline driven by an inventory correction first and foremost. That means we could potentially be heading into something that looks like the recession we had in 2009 during the financial crisis. That would be a worst case scenario. Then it would be the red line we're looking at. That means the amount of blank sailings the carriers are doing now, they're going to have to retain that throughout a large part of 2023 if they want to prevent a further rate collapse. We could have a more benign scenario. We could be in a scenario where the current recession we are currently in is not as deep as people are afraid of. We might get inflation under control. The Russia war might not spread. Consumers might become a bit more optimistic. In that case, we could actually see a boom in demand already in peak season. So May, June, July, 2023. That would be the optimistic scenario. But if that does not happen, then it's the red line here, reminiscent of the financial crisis scenario that we are more likely to see here over 2023. And if we then look at the capacity that's going to come on stream here in 23 and 24, there are massive order books about to be delivered in 23 and 24, far more than what the demand is going to grow, even in a positive scenario. We should keep in mind, though, that there is the potential effect of the new environmental rules that came into effect here in 2023. That means that there are certain regulations on vessels on fuel consumption, which in all likelihood is going to lead to some vessels having to sail slower. That's going to absorb capacity. The challenge with this is the impact of that. So the difference between the blue and orange lines is very uncertain. Most carriers right now seem not even to have a good firm idea of how it's going to even impact their own vessels. Some of the more consensus estimates that are out there is this might actually remove the equivalent of 10% of capacity in total during the full course of 23 and 24. That will lead to the blue lines. But even if that's the case, we're still looking at 3% capacity injection, and in a market demand environment which might be below zero here in 2023. So we are in all likelihood still going to see overcapacity in 23. That would basically be characterized as a normal cyclical downturn. So even in positive scenarios, there will still be a weak market in 23, likely in 24 as well, from a global perspective. And that brings me to the last slide I've elected to bring here is there are a couple of elements to watch out for over the coming months. The first element is, when will this inventory correction stop? In all likelihood, this will be done during Q1, so within the next couple of months. And every time in container shipping, when you had a major inventory correction downwards, there's always a surge of cargo happening afterwards, as the importers need to get back to normal operations. That will happen, but the question is when. It doesn't necessarily happen the moment the inventories are run down. It would have to also coincide with the economy picking back up. And that's why in a positive scenario, we could see that surge already in summer 23. But it might also be that this doesn't happen until the lead up to Chinese New Year 24, a year down the line. And we still has a potentially bad situation on the US West Coast. There's still no agreement between the terminal operators and the Port Workers Union. That means that you still have congestion issues on the US East Coast. A lot of US importers have shifted cargo away from the West Coast due to congestion last year, and they are not moving it back to the West Coast until there is an agreement. So what we should expect here is short term, the odds are now that we might get some labor action. So we might get more congestion before there is a deal. But we should also plan for the moment that there is a deal with the union, that there will be a significant shift in volume away from the US East Coast back to the US West Coast. This will rapidly improve the congestion situations that we see over on the US East Coast. What we're also likely to see unfold during 23 is a reshaping of the alliances. This was a hypothesis that I presented already 3 months ago, on the basis that MSC has such a large order book that they likely 2 years from now would like to operate independently. That would then force the 2M alliance to stop existing. That would leave Maersk without a partner, which in all likelihood would lead Maersk to look for another partner in the other alliances. You can also have a lot of arguments why the other alliances might not be all that stable. So the way I see this is during 2023, there will be negotiations between the different carriers that will result in the alliances as we know them today will be disbanded, and they will be reformed in a new shape in 2024. We've seen reshaping of alliances before in history. This is going to be another round of that. But that means there's going to be a lot of uncertainty during 23 into 24 in terms of what are the networks going to look like. There are increasing congestion challenges right now in China. They're somewhat unpredictable. China has gone from a zero COVID strategy to basically having 100% COVID strategy, which leads both supply chain companies, ports, production facilities in a little bit of disarray in terms of labor force availability. That's a temporary period, but as long as that goes on, that will lead to more congestion challenges in China. Given the massive downturn we've seen the last few months and where the market is today, that would also lead to, of course, a sharp worsening of the carrier's financial performance. That means all the carriers, they are already right now very busy trying to reorient themselves. The last couple of years, the carrier's focus has been purely on one thing: how can we get as high a freight rate as possible? Whereas focus on operational efficiency has not really been there. Why would you want to focus on saving a few $100s when you can make $5,000 more in increasing freight rates? That game has completely changed. All of the carriers will become much more focused on operational efficiency, much more focused on how can we save money in all the operations, much more focused on canceling sailings, doing whatever it takes to save money. And the final one is also, we're already beginning to see it, that we're going to see, because of all these blank sailings, the carriers do slot charters not within the current alliances or existing BSAs, but also across them. I think a very good example was the latest one was last week, with Hapag-Lloyd announcing a new Asia-Europe service. Well, they're not sailing any new vessels at all, but they're getting slots on board CMA CGM's vessels, which is an entirely different alliance. That is a logical consequence. If you cancel a lot of sailings, suddenly your network has holes, port pairs you're not covering. So when everybody can't fill their vessels, you get more of these slot charters. That also means it's going to be more difficult to get a good overview over the market in coming months as carriers begin to take more and more slots on board with each other, leaving for a more complex web of service offerings during 2023. That was setting the stage for where we are heading in here in 2023. Maybe to sum it up a bit, the market right now globally is extremely poor. There are certainly small niche trades here and there that for various reasons have not been materially impacted. They will come under pressure during 2023 as well. But overall, this is an extremely difficult time now for the carriers. If you are a cargo owner, a customer out there, especially on the major deep sea trades, it is tempting to start to negotiate full year contracts right after Chinese New Year, because you're going to be able to get some fantastically low deals on 1 year contracts. Just keep one thing in mind. If the recession is not that deep and the market does rebound in summer, if you negotiate an extremely good contract with the carrier right now, your chance of being able to book any cargo on that contract in a strong peak season becomes equal to zero as well. So I just want everybody to be mindful of that one as well. You can roll the dice and you get a good contract. And if the market is bad throughout 23, you'll be happy with that contract. But if the market does rebound, you're going to be forced over onto a much stronger spot market. So every customer out there needs to not just look at what's the dollar and cents, but what's the risk profile that you are happy to live with. That was a good question. This is going to be off the top of my head. If you looked at some of these Panamax vessels that before the pandemic were at around $10,000 a day, during the height last year went to 200,000. I believe they are down at 25 to 30,000 now. Pandemic, yes. And this is part of the pressure the carriers are under, because on one hand, you now have spot rates on both Trans-Pacific and Asia-Europe that are back to pre-pandemic levels, in some cases even lower. But the carriers, at least from a very high level perspective, have operating costs that are 30 to 40% higher than pre-pandemic. So the carriers are going to be very aggressive in trying to do something about that. No, I don't think Maersk want to be alone. Well, they might want to, but I don't think it's going to be advantageous for Maersk to be alone. Here's the challenge. MSC, with the order book they have, by the end of 2024, MSC could be as big as MSC and Maersk was combined back when they formed 2M. So MSC is going to be able to build their own global network that matches both Ocean Alliance and THE Alliance. Maersk, if they are on their own, will not be able to make a very large network. Can they make a global network? Yes, of course they can. But the number of weekly services they have will be a lot less than MSC and a lot less than the other two alliances. That would make Maersk a lot less flexible. So if you see this breakup, I would have an expectation that in order to be competitive, Maersk would have to find a new partner, either in a new alliance or in a looser constellation. But I find it hard to see Maersk can be competitive in the long run if they only have their own network. They might choose to do so, but I would not think it would be a wise choice. My own hypothesis on that, and that's purely my speculation, is that the best fit there would be CMA CGM. Not because the Maersk and CMA are good friends, they are not, but alliances are not about being friends. Alliances are marriages of convenience. And if I look across the opportunities out there, I mean, CMA CGM over an Ocean Alliance, they're going to be up against a COSCO that is government-driven. COSCO has lost a significant amount of market share the last 2 years because the Chinese have been focused on COVID. So I expect to see a very aggressive COSCO. And that's not going to sit well with CMA CGM. On top of that, in Ocean Alliance, the third party there is Evergreen. And with geopolitical tensions between China and Taiwan, that makes the alliance unstable as well. So CMA CGM potentially would be in the market for a new partner as well. One that's been mentioned a few times is, what about Hapag-Lloyd and Maersk? I don't see that happening. Basically because with the relative size differences, that would mean Hapag-Lloyd would be seen as the little brother to Maersk. I don't think anybody in Hamburg is willing to take upon themselves that role. Bottom line is, in the short term, the most the carriers can hope for by aggressively canceling more sailings is to prevent rates from dropping even further. And any hope of a sustainable rate pickup, that will not happen until, you can say, May, June, July, the normal peak season. And that would require the global economy to begin to take up again. Year, I don't have a good number for the full year, but I would expect it to be exceedingly high going forward. But I don't have a good number in percentage. No, 30% would be too aggressive. Again, if you're looking from a global perspective, the carriers would try to match whatever the demand decline is. If you look at the data here, with September, October, November being down more than 20% year on year on both Trans-Pacific and Asia-Europe, the carriers did not blank 20% capacity. That is the level they would have to go up to match this. They do it right now after Chinese New Year, but Chinese New Year is, of course, a specific period. What's going to be more interesting is once you get basically to the end of February, and it's too early yet to see how much the carriers want to blank. but you're going to need to see blankings on that level continue going forward. 13, but yes.
13
and that is increasingly beginning to be an issue. I do increasingly hear from market participants that depots are filling up, carriers are having internal work groups trying to figure out what do we do with all these excess containers. So that is now an increasing and very real problem. Yeah, I mean, I would definitely expect to see the carriers put in more capacity in those trades, but that will be more in the form of cascading ever larger vessels down there. The challenge you're going to be faced with in South America is, as you're seeing ever larger vessels also cascaded down there, it reduces the service frequency. It makes the services a lot less flexible. It creates more the potential for bottleneck issues in some of the key transshipment hubs. And with a large downturn in demand right now on Pacific and Asia, Europe in particular, the order book is going to spit out a lot more of the big vessels. They will go on Asia, Europe. So the expectation is you're going to see then vessels on Pacific go up in size as well during 23. And that will also have a spillover effect with larger vessels sent down to South America as one of the last long trades as well, to soak up some of these vessels. To some degree, the pattern we have seen the last few months matches what you saw back then as we entered the financial crisis. The unknown thing this time, which of course was also unknown back then, how long is the economic downturn going to last? But my expectation would also be just as back then, when the market comes back, it comes back rapidly and you're going to get this surge on the backside. But the timing is extremely unknown. Okay. That's my expectation. That I could certainly see that they might still allow, yes, because Venezuela is a very particular niche market down there. What I see COSCO being aggressive about is ramping up their volumes on all the major deep sea trades, but not necessarily focus on some of the smaller feeder legs for very small niche markets. So I could see that as something that COSCO might well allow to continue, especially also in the light that COSCO, like everybody else, has this massive excess of containers anyhow. No, I mean, the main comment I would have is, and that's also why I showed some of the rate developments and volume development specific to South America, is that you're to a significant degree, at least as a whole area, experiencing the same developments as we are seeing also on the Transpac to North America, as we are seeing on Asia to North Europe. The overall forces that play out are going to be the same. And then specifically in Venezuela, because you are a unique case down there, you are more of a niche market. So just like we saw on the Atlantic, you can have conditions that for a temporary period are different, but it's not sustainable in the long run. Yeah, you can say for 3 months, fine. A long-term contract, especially here in 2023, I would be very hesitant entering into those ones right now. I would likely not lock that in for more than 3 months or so. I would be very concerned that once you see all other trades begin to go down, that there would be one or other carrier that say, hang on a second, there's still a small pocket of profitability here. Let's try to put in some more capacity. In terms of financial performance, you mean for last year or for 2023? See some of the best performance come out of, for example, a Hapag-Lloyd. The development I've seen, I would say, especially over the last 3-4 months, seems to be that Hapag-Lloyd, amongst all the major carriers, is the one that's had the most success in trying to retain some of their contractual obligations and customers living up to it. So I think Hapag-Lloyd is the one for now that's probably best positioned in what we're going into. But then again, all the carriers also made a lot of money. They're still sitting on a mountain of cash. No, I think that's fine. Let me just stop the recording here.